The landscape of how big money moves is definitely shifting.
It really is. And you just can't ignore the increasing role crypto is playing in all that.
For sure.
Yeah.
Today, we're going to dive deep into this, well, fascinating world of on-chain lending.
And specifically the institutional yield markets that are, starting to really take hold.
It's pretty remarkable seeing how established financial ideas are being kind of re-engineered in this decentralized space.
Yeah, institutions, both the traditional kind and the crypto-native ones, they're actively exploring how blockchain can make lending, borrowing, all that stuff more efficient.
And create new opportunities, right?
Exactly.
Okay, so a key player, really kind of at the forefront here, connecting TradFi with DeFi, is Maple Finance.
Maple, yeah, they come up a lot.
And to get a real understanding of how they operate and maybe where this whole sector is headed, we've got some great insights.
Oh, yeah. Where from?
It's from a recent YouTube interview with Sid Powell. He's the CEO and co-founder of Maple Finance. He was on the Epicenter Podcast.
Oh, cool. Yeah, that sounds like a valuable look under the hood, hearing directly from someone, actually building in this space.
Right. About the challenges, the innovations, their vision. It's super insightful.
Definitely.
So our goal for this deep dive is pretty straightforward. Let's break down how Maple Finance actually facilitates this on-chain institutional lending.
Okay. So who's borrowing, who's lending?
Exactly. And the tech powering it all. And importantly, Sydney's perspective on the future, the future of finance.
Sounds good. Where should we start?
Okay, let's unpack this. Sid Powell's background is actually deeply rooted in traditional finance, which I think gives Maple a really unique lens here.
Yeah, that TradFi experience is important. What did he do?
He started in securitization at a major Australian commercial bank, basically helping lending companies package up and sell their loans to bigger investors, banks, capital markets.
Okay. So that securitization experience, it's more than just like a footnote. It's foundational. His understanding of how you package and distribute debt in traditional markets, that probably directly informed Maple's approach on chain, right? Even with crypto assets.
Makes sense. Then he moved into commercial lending to small and medium-sized businesses, SMEs.
Okay.
And this is actually where he first connected with his co-founder. So he's seen lending from the big picture and the ground level.
Got it. A broad perspective then.
But then, the crypto world called her. And in late 2018, he started thinking about how smart contracts could tokenize institutional lending.
Right. Late 2018. That's pretty early days still for this kind of thinking in DeFi.
Definitely. Imagine taking those, established but often kind of opaque processes of institutional lending and suddenly seeing the potential to make them more efficient, transparent, maybe accessible to more people through blockchain.
It's a powerful idea. But like any good origin story.
Oh, yeah. There were definitely some early missteps. Sydney's pretty open about making pretty much every mistake possible.
Oh, like what?
Including trying to build a peer-to-peer lending platform for anonymous individuals online.
Wow, okay. Yeah, that early attempt really highlights a critical learning curve, doesn't it, in those really nascent stages of DeFi.
For sure.
That initial promise of total decentralization had to smack up against the practicalities of managing risk and, the basic need for trust, especially with lending.
Exactly. So they eventually narrowed their focus to institutional lending, which when you think about their background.
Makes a lot more sense, yeah.
So what specific gap in the market were they trying to fill? Because even back then, early 2019, Sydney mentions there were already a few DeFi lending players.
Right. You had Maker, Set Protocol, DYDX, Dharma, Compound. They were around.
So what was Maple's angle?
Well, the crucial difference, I think, was the scale and the type of lending they were thinking about. Their initial concept was around creating, get this, infinitely scalable tokenized bonds.
Infinitely scalable?
Yeah. Think leveraging smart contracts to create really specific, maybe fractionalized layers of debt.
Okay, here's where it gets really interesting. In 2020, they started to really differentiate themselves, focusing on under-collateralized institutional loans.
Ah, okay. That's a big departure.
Huge departure from the over-collateralized models like Maker and Compound were using, right?
Absolutely. That shift to under-collateralized, that was a significant step for DeFi. I mean, over-collateralization is safe, sure, but it limits how efficiently capital can be used.
Right.
Under-collateralized lending, which is just, standard practice in TradFi for credit-worthy companies, it needs a much more sophisticated approach to risk.
Sydney described their early vision as building a credit fund on-chain.
Okay.
with professional underwriters and something called first loss capital. That sounds much more like how traditional credit funds work, doesn't it?
It does, but with that added layer of blockchain transparency, potentially.
But as he points out, under-collateralized lending is way more complex.
Oh, definitely. Yet you have to really understand risk underwriting, borrower reputation suddenly becomes critical. You need reliable price feeds. It's a lot harder than just demanding more collateral than the loan.
Yeah, no kidding. And initially, trying to get TradFi players on board.
Yeah,
People maybe with a lower risk appetite than crypto natives.
that must have been a hurdle.
He said it was, yeah. Like trying to convince someone used to, I don't know, government bonds to jump into a totally new, unfamiliar asset class.
Well, it speaks to the need for education, right? And
Yeah.
building trust between traditional finance and DeFi. TradFi needed to see the benefits, sure, but also be convinced the risks were managed properly.
Absolutely. Okay, let's look at how Mabel's actual business model evolved then. They
Mhm.
tried that peer-to-peer loan thing we mentioned.
Right, the anonymous one.
Yeah, but they ran into problem scaling it.
Yeah.
And those tricky, idiosyncratic consumer risks.
Yeah. Like just random personal stuff that makes someone default. Hard to predict or underwrite at scale.
Exactly. Peer-to-peer, while it sounds nice, direct connection.
It's tough to assess individual creditworthiness effectively across thousands of people and manage all the different ways things can go wrong.
So they pivoted,
Yeah.
shifted focus to lending to profitable crypto firms,
Okay, like who?
specifically market makers. He mentioned GSR as an example. These were companies making money in crypto.
But couldn't get traditional banking services easily.
Precisely. Especially in that low interest rate environment after COVID hit. Traditional banks weren't offering much.
So that was a really strategic pivot. It addressed a clear market need. These crypto firms needed financing for their operations, their growth.
And they were already comfortable in DeFi.
Right. Plus, low TradFi rates made DeFi yields look pretty attractive. Smart move.
Okay, let's dive into the tech side. What did their core setup look like initially, and has it changed?
All right. So, early days.
Yeah.
Purely on Ethereum.
Yeah.
Solidity code for the smart contract.
Standard stuff then.
Pretty much. Users deposited USDC, stablecoin, and got LP tokens back, representing their share of the pool. They also had this delegate or manager role, someone who set the loan terms, interest rate duration, amount.
And the loans themselves were smart contracts.
Yep, specifying all those terms. It demonstrated the basic capability, right? On-chain lending managed transparently via code, and the LP token was key for fractional ownership and some liquidity.
So what about now? How's the current stack look?
It's more of a hybrid now, blending CeFi and DeFi elements, still mostly Solidity on Ethereum mainnet, though.
Okay, still Ethereum focused.
Yeah. Users still get LP tokens, but now they're ERC 4626 Vault tokens. They automatically accrue yield in the USDC pools.
Ah, the 4626 standard. Got it. Any other big changes?
Well, a significant one, Maple now directly approves all the loan originations through their smart contracts.
So a bit more centralized on the approval front.
Seems like it. Probably reflects needing tighter control over underwriting and risk, especially as they got into, more complex stuff.
Makes sense. But here's a really interesting differentiator he mentioned. Borrowers can now post native assets like Bitcoin, Solana, XRP as collateral.
Okay, but how? If the main platform's on Ethereum.
Right. The management of that collateral happens off-chain through qualified custody providers. He mentioned Fireblocks.
Okay, that's clever. That hybrid approach solves a big problem. How do you handle collateral on all these different chains from an Ethereum base?
Exactly. Partnering with regulated custodians lets them securely hold a wider range of crypto without needing complex, maybe risky cross-chain bridges for every single collateral type.
That's a really pragmatic solution. Very interesting.
And they're also looking at using Layer Zero's OFT standard, omni-chain fungible token,
Layer 0, yeah, for cross-chain stuff.
potentially to make their LP tokens transferable across different blockchains.
Yeah.
Which could seriously broaden their reach, right?
Totally. Layer 0 acts like a universal translator. It could let their yield tokens be used, traded, whatever, on other networks. More access, more liquidity, big potential there.
Okay, switching gears slightly, but super important. Risk management, underwriting.
Crucial in lending, yeah.
Sydney mentioned a shift in their approach, moving from, balance sheet focused underwriting for those early under-collateralized loans to a more collateral-based approach for their over-collateralized products now.
Yeah, that makes perfect sense. It reflects the change in their main product. Collateral-based lending is more standardized, potentially more scalable for risk assessment, especially with volatile crypto assets.
They put a lot of emphasis on loan-to-value ratios, LTVs.
Standard practice.
He gave an example for Bitcoin loans. Maybe start at 70% LTV, trigger a margin call at 80%, and then liquidation kicks in at 85%.
Yep. Those thresholds are the safety net. Margin call is the warning, add more collateral. And liquidation is the backstop for the lenders if the price keeps falling and the borrower doesn't top up.
And naturally, the starting LTVs are lower for more volatile stuff like Solana or XRP.
Of course. You have to align the loan terms with the risk of the specific collateral. More volatile asset, bigger buffer needed.
So what goes into that underwriting? He mentioned you look at historical price swings.
Yeah, drawdowns, daily and weekly probably.
Liquidity on OTC desks, like how easily could they actually sell this stuff without crashing the price?
Crucial point, especially for larger positions.
And even if the collateral itself earns yield, like staking rewards, and how fast they could get that out if needed.
Right, like unstaking periods, all factors into the real risk profile.
Now, here's another really interesting bit. How market conditions affect the actual lending rates.
Ah, yeah, supply and demand.
He pointed out that rates for lending against Bitcoin really compressed in early 2025, went down.
That makes sense. It's just market forces. If more people want to borrow Bitcoin, or if there's more capital available to lend against Bitcoin, rates will naturally get pushed down.
And they're also seeing spreads widen between what they call investment-grade collateral, like Bitcoin,
The safer stuff.
and high-yield collateral, like some altcoins, which intuitively makes sense, right? Higher perceived risk usually means lenders want higher potential returns.
Exactly. Those widening spreads are basically the market pricing in the relative risk and liquidity of different assets. You'll demand a bigger premium to lend against something seen as more volatile or harder to sell quickly.
Okay, let's shift gears again. Who's actually using Mabel? Their customer base has changed a bit.
Yeah, how so?
For those initial under-collateralized loans, the main borrowers were market makers.
Okay.
But that's not really the focus now for the over-collateralized loans.
Interesting. Why the shift away from market makers for OC loans?
Sydney explained that market makers, their whole business is providing liquidity, swapping assets cheaply.
Right.
So tying up extra capital as collateral in an over-collateralized loan might not always be the most efficient use of their funds compared to just, trading.
Ah, okay. Opportunity cost. Makes sense.
So now, for the over-collateralized lending, they're seeing more prime brokers, firms offering margin, facilitating OTC trades. He mentioned Galaxy, Hidden Road.
Okay, yeah. They need capital for their operations.
Also more on-chain hedge funds and yield funds. People using leverage on platforms like Pendle or Athena.
Right. Trying to juice returns on yield strategies. OC loans give them leverage without selling their base assets.
Liquid token funds leveraging positions too. And increasingly, family offices and high net worth individuals.
Really? TradFi money coming in more.
Yeah.
Yeah.
Often people wanting to leverage their crypto for, say, buying real estate, but they want stable rates and really want to avoid liquidation risk. So they over-collateralize significantly.
That's a big sign of maturation, isn't it? Growing comfort from traditional wealth with these platforms, focusing on capital preservation and predictable costs.
Definitely. And on the lending side, the yield side for depositors, who's providing the capital?
Good question. Where's the money coming from?
Similar groups, actually. High net worth individuals, family offices, professional asset managers, he mentioned foundations, and even corporate treasuries.
Corporate treasuries, wow.
Yeah, exploring Bitcoin and ETH-backed lending as a kind of on-chain money market alternative.
That's another strong signal of maturity. Established capital allocators trusting the system, seeing the potential for decent risk-adjusted yields there.
So what actual crypto assets are being used for collateral, and what are people borrowing?
Yeah, the specifics.
Collateral examples he gave: Bitcoin, ETH, Solana, XRP, DOT, Polkadot. Also some more niche things like PT tokens for SESD from Pendle, Athena, Treehouse, ETH, Lombard, BTC.
Okay, quite a mix.
But he said they actively lend against fewer than a dozen types right now.
That makes sense. That concentrated approach probably reflects the heavy lifting involved in the due diligence for each asset, right? Managing the specific risks and liquidity.
Totally. The DD process for new collateral sounds pretty thorough.
What does it involve?
In-depth smart contract reviews, checking audit reports, making sure there's wallet support from the big custodians, Fireblocks, Porto, Copper.
The practical stuff.
And assessing OTC liquidity again. Interestingly, he mentioned they twice declined to onboard USD 0 Plus as collateral.
That rigorous vetting really underscores their focus on risk management. They're not just listing everything. They're carefully checking the tech, security, market dynamics.
Exactly. Now, on the borrowing side, what are people actually borrowing?
Mostly stablecoins, I assume.
Overwhelmingly, yeah. primarily fiat, represented as USDC. But there have been exceptions.
Like what?
He mentioned instances where they lent Solana to firms hedging positions related to the locked SOL from the FTX estate.
Oh, wow. That really shows the flexibility, doesn't it? On-chain lending facilitating unique market situations and specific hedging needs that pop up in crypto.
For sure. Okay, deployment. Where's Maple actually running? Across which networks?
Good question. Is it multi-chain?
Primarily Ethereum. That's been the main focus. They did have past deployments on Solana.
Ah, but Solana had that big market downturn post-2022.
Exactly. And also on Base, where he said their T-bill product in 2023 didn't get much uptake.
So those experiences kind of highlight the challenges of going multi-chain in DeFi, right?
Yeah.
And the importance of network effects and liquidity concentration.
That's what Sydney believes. Ethereum's dominance here comes from its established lending network effects, the sheer amount of stablecoin liquidity, USDC, USDT especially.
And the institutional wallet and custody support, Fireblocks, Anchorage, etc.
Right. Those factors create this reinforcing cycle, pulling more users and capital to Ethereum for lending and borrowing, cementing its lid.
Makes sense.
And interestingly, he pointed out that transaction costs on Ethereum, high gas fees,
Yeah, always a complaint.
are less of a big deal for yield products compared to, say, high-frequency trading.
Ah, good point. For longer-term yield strategies, a one-off deposit or withdrawal fee doesn't hit the overall return as much as constant trading fees would.
So maybe the higher fees haven't deterred their users as much. But looking ahead,
They're looking elsewhere again.
yeah, renewed interest in deploying on Base and Solana.
Yeah.
And they're said to be a launch partner on Converge,
Converge. What's that?
the upcoming chain from Athena Labs and Securitize.
Ah, okay. So strategic expansions to tap into growing liquidity or user bases on other promising chains, especially ones attracting institutional interest or doing innovative yield stuff.
Seems like it. The main hurdle, though, engineering resources.
Oh, the practicalities.
Supporting new chains properly needs significant effort. Building subgraphs for data indexing, developing user-friendly web apps. It's not just copy-pasting smart contracts.
Yeah, maintaining that infrastructure across multiple chains takes serious technical chops and ongoing work.
Now, something surprising. Oracles.
Yeah, crucial for DeFi price feeds, right?
You'd think so.
Yeah,
But Sydney mentioned they aren't as integral to their current operations as you might expect.
how come?
Mainly because that collateral management happens off-chain in those custody solutions.
Ah, right. So they can rely on data feeds from the custodians and exchange APIs instead of decentralized oracles for pricing.
Pretty much. They use APIs from places like Coinbase, data aggregators like CoinGecko as backups.
Okay, but what if they move towards on-chain liquidation?
Then, yeah, he anticipates potentially relying much more heavily on decentralized oracles if they shift to a model where liquidations are fully automated by smart contracts on-chain.
Then robust, reliable, decentralized price feeds become absolutely essential. You need accurate, trustless data to trigger those liquidations correctly. Makes sense.
Okay, what about the retail market? We know Maple's focused mainly on institutions.
Right. Why that focus?
Sydney explained it was driven by a couple of things. Higher potential fees from bigger institutional loans justifies the underwriting effort.
Okay, better economics per loan.
And also, frankly, a less complex regulatory landscape compared to dealing with retail customers.
Yeah. Servicing institutions means leveraging specialized underwriting on bigger amounts, so more revenue per deal.
Yeah.
And the rules for institutional lending are generally less complex than consumer protection regs for retail.
But the retail market does have advantages, right? Like potentially better pricing power, charging higher interest rates.
True. But Sydney pointed out the big downsides. Much higher customer service needs.
Oh yeah, imagine the support tickets.
Exactly. Plus, significant licensing hoops to jump through: money transmitter licenses, consumer lending licenses, varies by jurisdiction, gets complex fast.
And greater potential for customer disputes, presumably.
Definitely. Serving a broad retail base needs huge investment in customer support. And navigating consumer protection law and getting all the licenses is a massive barrier.
So their current strategy is basically exhaust the institutional market first, really maximize opportunities there before seriously thinking about a big retail push.
Makes sense. Build a strong foundation, refine processes, navigate the easier regulatory path first. He mentioned looking at firms like Apollo and Ares.
Right, who mostly focus on institutional lending too, kind of a model.
So future expansion might be tied more to tokenizing more asset types.
Could be. And lending to even more types of institutions as the market evolves.
As more real-world assets get tokenized and the on-chain ecosystem matures, you'll likely see new opportunities pop up for lending against those new tokenized assets.
Okay, let's touch on the less glamorous but totally critical part, managing defaults.
Yeah. What happens when things go wrong?
Since September 2023, with their over-collateralized lending, he said they've had dozens of margin calls, but only one instance of a partial liquidation
Only one. When was that?
during that big yen carry trade unwind in August 2024.
Wow. That's a pretty low liquidation rate, especially given crypto volatility. Speaks well for their underwriting and the quality of their borrowers, I guess.
Seems like it. Interestingly, he also mentioned they often see higher volatility on Sunday nights.
Huh. Yeah, the infamous Sunday night crypto dump. Lower liquidity as traditional markets are closed.
Right, so they really emphasize underwriting institutions that have the financial strength to actually meet margin calls if they happen.
That's a key difference from maybe less sophisticated retail borrowers who might struggle to react quickly. Focusing on financially robust institutions reduces the chance of defaults and forced liquidations.
And their approach to liquidation itself is noteworthy. They do partial liquidations.
Instead of full liquidation like on a Fove or Maker.
Yeah. Sydney thinks it's more borrower-friendly.
Yeah, I can see that. A partial liquidation is less disruptive, lets the borrower keep some collateral instead of a complete fire sale of their position.
They have automated price alerts and margin calls, but the actual selling of collateral is done manually right now.
Manually. Seems less definitive.
Maybe, but Sydney says their institutional clients actually prefer that human oversight. They're often wary of fully automated liquidations run entirely by smart contracts.
Ah, okay. That human element provides flexibility, communication maybe, which can be reassuring for big clients with large positions. Interesting trade-off.
So what about current market conditions? How's that affecting things?
Yeah, what's the vibe right now?
Sydney noted borrowing rates have generally come down, partly due to the lower Bitcoin price recently and lower funding rates overall.
Makes sense. Lower prices, slower trading, less demand for leverage usually means lower borrowing costs.
But on the lending side, the yield being offered is still pretty strong.
Oh, yeah. Why is that?
Driven by increased stablecoin holdings market-wide, people have cash on the sidelines, and there's still demand for yield opportunities, especially in a sideways market like we've seen.
Right. When things are flat, people look hard for ways to make their stablecoins work for them. So platforms like Maple with established pools become attractive.
Of course, he cautions, borrowing demand in crypto can shift super fast.
Oh, yeah. One big market move and the whole picture changes. Very dynamic.
Definitely. Now let's talk real-world assets, RWA tokenization.
Hot topic. How does Maple fit in?
Sydney aptly describes Maple as essentially tokenized private credit, which I think really nails it.
That's a good frame. Highlights the link between traditional private credit and what they're doing on-chain and DeFi.
He also emphasized the unique value prop of Bitcoin-backed loans as a TradFi alternative, offering potentially good yields, relatively short duration.
Yeah, Bitcoin-backed loans are this novel asset class. Competitive yields compared to some traditional fixed income, plus the transparency and efficiency of blockchain.
They've even lent against tokenized receivables before, high yield, short duration stuff.
Tokenized receivables. That's a direct link between real-world business activity and DeFi. Potential for more efficient short-term business financing there.
But Sydney highlighted a key challenge for broader RWA adoption on-chain.
What's that?
A lack of buy-side demand, basically. Institutions often have established off-chain ways to invest in these assets.
Right. And on-chain investors often have shorter time horizons than traditional RWA issuers, maybe.
Exactly. That mismatch, plus the existing off-chain infrastructure, creates hurdles for widespread RWA adoption in DeFi right now.
Makes sense. Challenges remain.
Despite that, he sees big potential for growth as stablecoin use increases and the on-chain off-chain worlds converge more.
And he said Maple's ready to lend against RWAs if the demand shows up on-chain.
Yep. They're willing if the buy side is there.
So what's his prediction? Long term.
Pretty bullish. He anticipates significant growth in both institutional lending and RWA lending happening on-chain within, say, 5 to 10 years.
Wow. Driven by what, mainly?
Largely by the advantages stablecoins offer for transactions, their efficiency.
That's a compelling outlook. Stablecoins is the grease for the wheels, driving more activity on-chain.
So, looking back, what were some of the biggest technical hurdles they faced getting here?
Good question. What were the main pain points?
He pointed to fiat on-ramps and off-ramps, still a major challenge. Moving traditional money onto the blockchain and back smoothly is still a big friction point.
Oh, yeah. That fiat to crypto bridge is still clunky and costly, a huge barrier for bigger institutional adoption.
Also, the prevalence and sheer volume of stablecoins issued. They're the lifebloods, right?
Absolutely. A bigger, more liquid stablecoin market is essential for on-chain lending and borrowing to scale efficiently.
And cross-chain compatibility for deposits. Letting users easily bring collateral from various chains. That's another technical challenge they're tackling with Layer 0.
Right. Making it seamless to deposit collateral from anywhere would massively boost accessibility and liquidity for their pools.
Looking ahead then, what exciting tech does Maple have its eye on for future growth?
What's next on the innovation front?
Artificial intelligence, AI, that's a big one.
AI and DeFi. How?
They see potential in risk monitoring, predicting collateral liquidations maybe, enhancing underwriting, assessing loans, auditing smart contracts, just general operational efficiency.
Interesting. Faster, more data-driven decisions, maybe uncovering insights humans miss?
They even have a pilot program running for AI-powered collateral assessment already.
Wow, okay. That's forward thinking. And besides AI?
Cross-chain solutions, of course, still key for broader accessibility across different ecosystems.
Makes sense. Interoperability is crucial for DeFi's full potential.
So what's actually on the roadmap for the next year or so?
Yeah, what are they building now?
A key focus is Bitcoin structured products. They have this interesting partnership with Core DAO,
Core DAO.
aimed at providing Bitcoin on Bitcoin yield with integrated custody. The idea is basically turning native BTC into a liquid stake token, an LST, that can then be used as yield-bearing collateral.
Ah, native Bitcoin yield within a secure setup. That definitely addresses a growing demand from institutions wanting passive income on their Bitcoin.
Sydney really believes in the growth potential there.
Yeah.
Sees it as a natural next step for new institutional players coming into crypto. It's an asset they know, Bitcoin, but with yield added.
Yeah, for institutions new to crypto, Bitcoin is often the entry point. Offering yield on it provides a comfortable way for them to start participating more deeply in DeFi. Smart product.
Okay, one last area. The correlation between crypto and traditional markets.
Yeah, the million-dollar question. Is Bitcoin risk on or risk off?
Sydney observes that right now, Bitcoin tends to trade more like a growth asset, driven by new adoption inflows. So it correlates more with things like the NASDAQ, tech stocks.
Yeah, that seems right. Reflects the current investor base, a lot of growth-focused money.
He thinks for Bitcoin to really shift into being seen as a defensive asset, like a traditional safe haven.
Like gold, maybe?
Yeah. It would need much broader global adoption and a significantly higher chunk of portfolios allocated to Bitcoin. He figures that's probably still 5 or more years away.
That makes sense. For Bitcoin to be truly seen as safe haven, it needs to show resilience in downturns consistently and just be a much bigger, more stable part of global portfolios. Long road, maybe.
So wrapping up this deep dive into Maple Finance and this whole on-chain institutional lending space, we've really seen how that traditional finance expertise is merging with DeFi innovation.
Yeah, creating new ways for lending and generating yield. What really stands out is Maple's approach seems quite pragmatic, thoughtful.
Right. Focusing on institutional needs, navigating regulations carefully, prioritizing risk management in a fast-moving market.
Yeah.
So hopefully you listening now have a much clearer picture of how Maple operates, who's involved in the space, borrowers, lenders, and some of the key tech and market forces shaping where it's all going.
Which really brings up a big question for you to think about. As you hear about tokenizing more assets, making lending more efficient on-chain, how might these trends reshape finance overall?
Yeah. And what role might you or maybe your organization play in that evolution? Something to chew on.
Definitely.
If you want to dig deeper into Maple Finance, check out their website, maple.finance.
And they're active on X, right?
Yeah, you can follow them at Maple Finance. And Sidney Powell himself is at SirupSid. Lots of good info there.
Cool. Well, that was a fascinating look at a really important part of the evolving crypto landscape.
Absolutely. Thanks for joining us for this deep dive.